The Federal Reserve just dropped interest rates. What does this mean for you as a real estate investor? Well, today on the Lady Landlords Podcast, that's exactly what we're going to be talking about. When this was announced last week, all over the news, I went immediately to our Lady Landlords Facebook community and shared this information. And the feedback we got and the misconceptions in there are exactly why I am making this podcast episode today. So, where does this all come from? Well, clearly, as we all know, interest rates in the United States have been rather high. That's in addition to dealing with problems with inflation that have just been plaguing us now for quite a few years. It was very much anticipated that there would be this drop in interest rates. And it was really talked about how there was going to be a cut by the Fed. Most people were actually predicting there was going to be a 0.25 basis points drop. And that's what people were really starting to anticipate. What that meant, though, is when we already knew that that meeting was going to be taking place, and that was probably what was going to happen. This was actually going to be the first time in years that the Feds actually cut that rate. This was something that lenders, banks, institutions knew about. We knew this was coming, right? Because of that, a lot of real estate investors, since that's really where our focus is here on this podcast community, started thinking about those HELOCs. Started thinking about those refinancing, started thinking about if they were going to go out and start to shop for either a new rental property or even a new home for themselves. Last week, this then came out that the Feds decided to drop it 0.5%, twice as much as really what was being predicted by most major news outlets. Well, that was a bit of a shock for a lot of people. What was interesting was we talk about that in Lady Landlords, and a lot of people felt that that was actually speaking specifically to mortgage rates. And that is not the same, okay? When the Federal Reserve decides to drop that interest rate, that actually is not a direct correlation to what's going to happen in mortgage. That's also the same as it's not exactly going to be the same as what would be now a new interest rate for a HELOC or what that's going to be on your credit card or what that's going to be for your car loan. Those are not necessarily exactly the same. So let's talk about what that actually does do. With that interest rate now being dropped, or anytime it actually increases or decreases, let's talk about really what that means. Over the past couple of years, in case you forgot, we had a pandemic, right? During that pandemic, we had a lot of people that were out of work, a lot of people that lost jobs, had to change jobs, whatever that might have looked like at that point in time. And there was a lot of stimulus money that was going out. There were a lot of people that were being given money. The government really was helping make sure to keep the economy going at that point in time. People always have one of two choices that they get to do with their money. You can either save it or you can spend it, okay? With dropping interest rates as low as they went, we all remember back in now 2020, 2021, that interest rates dropped to this absolute lowest rates we have ever seen and probably will ever see again in our lifetime. The reason that happened, the reason why rates come down so much is because really the government wants us to go out there and start spending our money. They want us to get money into circulation. They don't want us just sitting home saving money at that point in time. That's why at that point, when so many people lost their jobs, what do most people think to do? Well, I got to cut back on my budget. Maybe I shouldn't be traveling right now. Have no idea what's going to happen in the world. Now, when you multiply that by the millions of people that were now out of work during the pandemic, that was a lot of people that now were saying, hey, I need to now not go and consume certain types of goods because now I have to be able to save that money. So by dropping interest rates, it allowed for the Federal Reserve, when they did that, the intention was to get people out there to borrow money. It made it very, very cheap to borrow money, right? But as we all saw, a lot of people went out there and did just that. They were able to pick up new houses. They were able to move. They started buying rental properties. A lot of people bought short-term rentals as well, second homes, whatever that may be. There was a huge uptick in the amount of home improvement projects that were also done during this period of time. Well, what happened then was now because of that, there was a lot of inflation that was going on, and we needed to kind of swing a little bit in the other direction. With those rates now being increased, now all of a sudden that kind of created a little bit of a barrier to entry. Now it was much more expensive to borrow money. So a lot of people started savings again. If you have a high yield savings account, or if you've invested in CDs, bonds, anything in that nature, you'll notice also an inverse correlation with that. What I mean by that is back then, years ago, all of a sudden interest rates were so low, and you had so many people that were able to go out there, get loans, buy houses, buy rentals, whatever it may be. But I'm doing air quotes over here, your high yield savings account was bringing you like 0.2. right? Those numbers were so low that if you were a saver, you were kind of upset about it. You were like, what do you mean? I have all this money in the bank. I'm trying to increase my savings, but my quote unquote high yield savings account isn't actually yielding me anything. And it's definitely not high. Well, this increase in interest rates that we saw then 2022, 2023 was really to kind of reverse that. That was actually supposed to slow spending, get really a handle back on what was going on in inflation, and make the cost of borrowing money more expensive, and really kind of force Americans to be in more of a saving position to be able to put those back. You notice that interest rates went high, but once again, to all my savers out there, you've probably loved the past 2 years. Now your high yield savings accounts, your CDs are actually getting a better earnings than they were in 2020, 2021, right? Well, this now is that first shift that we're now saying, okay, interest rates are going to be able to be dropped a little bit. Once again, that was a 0.5 basis points drop that the Federal Reserve did a couple of days ago. And by doing that, that's kind of saying like, okay, people, we might have gotten a control on inflation here. Okay, we can start going back out there, start being able to have a cheaper cost of borrowing money. So what this is going to do for the savers is it's really going to make them happy, right? So this is actually probably going to make some of our savers not all so happy, because what this is going to do is now this is probably going to drop the interest that a saver would be getting on their high yield savings account again, or their CD, because really what the government wants us to do at this point in time is to start thinking about getting out there and putting our money back into circulation, not putting it into a savings account. So the interest that we're going to be getting on high yield savings accounts, CDs, is probably going to go down a little bit, right? But what we're thinking about then is what is going to be that impact to allow people to get that cheaper cost of a loan again. This is where there's going to be an impact on, once again, home loans, mortgages, HELOCs, credit card rates, car loans, all those different types of things. The thing is that we're not going to see that today. All because the Federal Reserve dropped that basis point, 0.5%, does not mean that that is the direct relationship that we're going to see with mortgage. We have to really see what that's going to do now, and that's going to take a little bit of time. One of the reasons for that is because there was already this anticipation that interest rates would be dropping for mortgages. So a lot of people started to go out there and started to talk to their lenders about refinancing, getting HELOCs, getting pre-approved, all of those different things. So when interest rates lowered, well, now we might see some more competition again. So many people, I've talked about this multiple times on this podcast, so many people have been waiting and waiting and waiting and waiting for interest rates to drop so they could go out and then buy that home. Not just us as real estate investors that are saying, well, hey, we want to make sure that those interest rates drop before we go and buy our next rental property. But we also have a lot of people that we are now competing with that are looking for their forever home, the place that they want to raise their family and live in one place for the rest of their lives. They haven't been able to do that in years. One, because everybody and their brother went out and bought and sold a house back in 2020 and 2021. And there has not been as much stuff on the market the past few years because so many people have moved. But also because these rates are so high, in addition to the competition we saw in 2020 and 2021, in 2022 for that matter, but also the fact that we've seen an increase in the sale price. Remember that fun word, inflation? We've also seen that supply and demand come into play here. All of these different factors has kept those things high. So now, what I feel we're probably going to end up seeing, interest rates even that tiny little bit lower, and how that really is going to make a difference to our monthly payment is still yet to be seen. But now we're going to see a lot more people out there that are going to be buying, not just investors, but other people that are really looking for their forever home, which means that's going to put competition back out there. Okay. Remember back during the pandemic, everybody waiving those contingencies. I wouldn't be surprised if we ended up in a similar situation like that. But now prices are going to be where they are now, with still where the interest rates are and getting that competition back out there. There's really no reason for sellers to actually have to drop their prices, right? Years ago, it used to have to be the idea that sellers would have to drop their prices a little bit to have to deal with the fact that interest rates are really high. But now interest rates were just lowered. So why would a seller say, okay, well, I want to make sure to lower my sale price so that way a buyer would have a similar monthly payment regardless of that interest rate? Nuh-uh, not applicable here. Now also you have that level of competition out there. Now we're going to continue to see these high record-breaking prices for real estate. We are going to still now see higher competition because it's the first time that rates have finally dropped. One of the reasons why we haven't seen a mortgage drop since this announcement was because so many people that were already putting in their applications waiting for this announcement. That anticipation actually kind of drove rates up a little bit. But I think we're going to get out there and we're going to see there's this tiny little blip of a little bit of a lower interest rate. Because of that, we're going to continue to see high sell prices, and now we're going to see even more competition. I say this all, one, because I want to make sure that we as lady landlords, we understand what this change means. We need to overlook all of the different moving pieces of what our economy is doing. But still, my recommendation to all of our lady landlords out there is not to worry about where that rate is, if that number is higher or lower, but really to start to learn the different strategies on how to pivot regardless of where interest rates are. What I mean by that is that I was still out there buying. I was still finding deals at 8%. I think 8.5% was the highest interest rate that I have in any of my properties currently. And that was actually through a conventional investment property. Because of that, if I can still make money at 8.5%, could you imagine what I'm going to be able to do with that when that number's down at 5s, right? What we need to start looking at is what is the overall strategy of what we're doing and how do we pivot and navigate any market rather than just trying to time the market, because anybody that times the market, you're always going to lose. All right. Best option, get in the market now by making smart, data-driven decisions, but understand how to do that regardless of what your market is actually yielding at that exact particular time. We are in it for the long game, and we need to understand how to move and pivot our strategy just as fast as the economy does. So thank you very much. I hope this information helps you out there. If so, please make sure to leave me a comment down in the show notes. Otherwise, make sure to hit that subscribe button so you do not miss the next episode of the Lady Landlords Podcast. We release new episodes every single Tuesday. Thanks so much for joining me today, and I will see you on the next episode of the Lady Landlords Podcast.
Thank you for listening to the Lady Landlords Podcast. If you're feeling stuck in your real estate investing journey, visit lady-landlords.com to book a 15-minute orientation call with me and see if you're ready to join our mentorship program. Or you can subscribe to our newsletter and join our Facebook group for exclusive real estate investing tips and offers. Invest with confidence. Become a Lady Landlord today.